Welcome everyone. Welcome to another episode of Wealth Talk by Vivekam. So, like we have introduced you over the past few weeks, Wealth Talk is a weekly series of videos that we make from Vivekam, where we try and enlighten investors and clients specifically in financial markets. So today, let us try and handle a few topics about the upcoming news, reaction to those news, and how it impacts us as investors. So first and foremost, there is speculation going around, at least for the upcoming budget, that F&O will be taxed a bit differently. So far, derivatives have been taxed under the head of business income, which means suppose I was making some loss in my business and I was making profit in my F&O trades, I could set off those two. But there is speculation going along that these derivatives may now be soon tracked as speculative income, which is akin to lottery or something like crypto, where there is a straightaway taxation of around 30 or 35%, whatever is going to be finalized, is what the government is at least mulling, and whether that becomes a realization or not is only for a few more days for us to see. So, Mr. Prasad, before we dig too deep into kind of other topics, we always say, because a lot of people come to us, they lose their hard earned money in trading. They are always on the prowl for trying to get some action into speculation and doing kind of derivative trading and option trading, which we believe at least is very, very risky for retail investors at least. So, what kind of impact may this move that the government is thinking of have for a retail investor?
Number one, as you rightly described, Ashwant, unless you are able to set off the possible loss in derivatives with other incomes, or vice versa, or if you lose money in business and if you make money in derivatives, if they are not allowed to be set off against each other, then what happens is that the consequences can be disastrous for the investors. Why? Because suppose you make money in your business and you lose money in derivatives, as you rightly said, the government will ask you to pay the tax on the income you generated in the business, because that is not going to be allowed to be set off with the derivatives loss, which means you will have to make more money in derivatives in the next year to recoup the loss that you made in the current year. That means there will be a compulsion on you to continue to indulge in trading and speculation in the next year also. That will be very, very bad situation, because many people try with a small amount of money, a large amount of money, and once a lesson is learned, they try to shy away from their business and then try to behave normally. But in this situation, if this regulation is brought in, as per the rumor mill going around in the markets these days, then what happens is the loss that you suffered today or this year, you will have to try next year only to recover from that. Otherwise, it will be going to be waste. So your cash is gone. The only way to recover is indulge in trading again. That is a bad situation, as we clearly explained. The same way, another thing you need to understand, every investor must be aware of a concept called zero-sum game. Many people try to understand or try to believe that if they make money in equity market, if they make some profit, somebody must have suffered a loss. They don't understand the basics. They only try to believe that his gain is someone else's loss or his loss is someone else's gain. That is why they keep on attributing some vested interest in the market, trying to kind of take money away from the retail investors. This is not correct. What is not correct is zero-sum game is limited only to the derivatives. Why? I'll tell you. Before that, I also need to tell you what is the difference between equities and derivatives prima facie. Equities have started, like let us some company like Reliance may have started 40 years back. That was there from that day. That is today also is available. That will be available for tomorrow also. A person who has bought the Reliance shares in the initial public issue of 10 rupees, he may have sold it at around 11 rupees. Now, if you have bought the share at 11 rupees and now you sold at 15 rupees, you tend to believe that 11 to 15 you made money, so that 4 rupees must be lost to the guy who sold. No, he bought it at 10 rupees and then sold it to you at 11 rupees. So he also made money, you also made money. Nobody suffered any loss just because you made money. The whole value of the asset has gone up. That is why the asset appreciation is distributed across all the patient investors. Now, let us take the other case around. If you have bought at around 2,900 Reliance only, and then by you are afraid of, you sold it at 2,700. and you believe that the 200 rupees loss suffered by you must be gained by someone else. It need not be, because the person who bought at 10 rupees may have sold at 2,900, and the person who has sold may not have come back to the market, only he went away. So that means he made the profit and went away. When you sold it at 2,700, somebody may have just entered now. That means he may continue till it becomes 4,000. So he also will make money. So just because you lost money, that loss alone will not go to someone else. That is not correct. That is not true in equity market, because starting and ending periods are not common for any two investors. But in derivatives, unfortunately, the derivatives take life on a given day, and they will be in existence only for 3 months time or 4 months time or some time, normally 1 to 3 months time, and that will be only available and actively traded. And any loss that you suffered, 100% someone else must have made money. If not one person, if you have lost 1 lakh of rupees, 10 people may have together made about a lakh of rupees on the trade. So your loss is somebody's gain, in which means your gain is somebody's loss. That is why there is a big incentive for operators to induce you into the wrong trades by forcing you to go to the technicals. They try to create a pattern, because you must understand, technicals are formed after prices are traded in the market. Now, everybody knows what is OECD or what is like kind of moving average, all the kind of technical indicators. Whatever the pattern that you would be falling trap into, they can create the trap by forcibly making a trades at the given prices. Obviously, there will be a trend created, and you get trapped into that. Once you get trapped into that, it is easy to kill you, because they will create the opposite pattern also to scare you, so that you square off your position and go away. So that is why 95% of the people, retail investors who trade in derivatives, are losing money. I don't say derivatives are bad. All that I'm saying is there's a big incentive for people to do this in derivatives, because your loss is going to be somebody's profit. But again, to counter my own argument, I can tell you, if you're holding shares and if you're only using the derivatives for hedging, you have nothing to lose. The only thing is, for example, if you have Reliance shares and sell an option in Reliance, at the most, you may be happy only with the premium that you got, and when the price goes up, you have to lose your Reliance share. That means you have exited from the Reliance stock. That is the only exception. Otherwise, every profit and loss of naked positions is equal to each other. That is the reason why we normally discourage. We never ventured into advising anybody on derivatives. We will also never venture into advising anybody on derivatives, because speculation is something which is not good for retail investors. Having said that, stay away from that, and the government also is becoming very strict on that. So why unnecessarily get into investment, into speculation? If you cannot stop that itch in your hand, maybe limit your exposure to probably 5% of your total net worth or total investable surplus. Beyond that, don't play in derivatives. Be happy with investments, because they give you much higher returns and peace of mind also.
So now let us also dig into a few more things, because we have many new viewers tuning into us. So we at Vivekam ascertain purely based on fundamentals, based on trailing 12 months of the fundamentals, and ascertain a fair price for each and every company that is traded on the exchange per period of the next quarter. So once there are new results that come in, we revise our fair value and give out a revised fair value that is pertinent to the latest available data that has been given to us by the company's quarterly results. So we talk about this topic a lot in our public forums and also in interactions with our clients and investors. But a lot of viewers sometimes have expressed concern about the validity of this fair price, why there is a value to sticking to something like a fair price, what kind of upside you are losing if you as the investor sell out at the fair price, many different kinds of questions. Because at Vivekam, we believe once a stock reaches its fair price for the quarter, it is pertinent that you sell without fail. You move the proceeds from that amount into something that is more highly valuable than trying to attempt to capture the full juice or potential of one stock. Because there is no way one person or any person in this world can estimate that this is the range of the stock that it will go to, and then it will retreat, and then it will go to something else and retreat. If there is a person like that, anyway, he would not be advising any of us. He would be making zillions on his own. But regardless, so Mr. Prasad, I just want to loop you in just to maybe touch upon a few points on the value of something like a fair price.
In fact, giving a target price or so-called fair price is the term that we are using, but whereas most of the people give out the target price. In their mind, they think the target price is nothing but a fair price applicable after 3 years' time. In that, according to our philosophy, there is a flaw. Number one, if you can forecast what is going to happen after 3 years, then it is all perfectly valid. But there are so many ifs and buts put in by the analysts by which the investor would not know that the price is valid or the conditions are valid, because only when all the conditions assumed or kind of situations assumed by the analyst hold true, then his fair value will assume significance. Otherwise, what happens if there are any of this kind of no estimations or assessments go wrong, then fair value also is not valid. But why it has come? Because over a period of last 4 or 5 decades, investors in the country have been made to believe that the best thing to do is just buy and forget it. That is given with an understanding or with a belief by the analysts that they are only the people who can analyze the numbers better, and investors lack that skill, lack that ability, lack that source of information, and they don't have the data also to process. That is why they are trying to give only the price. And next thing is, advisors have not been paid by any investor in the country for the last 4 or 5 decades. Having said that, brokers only were giving advice to the clients. The brokers have a big incentive to generate the volume so they get the brokerage. So why they were giving the targets was, if they give a target to you, Ashwant, saying that Reliance is a good buy at 2,900 and you buy it, and next day some other person comes, they don't want to tell any other company. They will say 2,900 is the Reliance today, it is likely to become 5,000 in 3 years. That means the dealers in the broker's office can keep on talking only about Reliance, because the owners of the brokerage firm also believe that their dealers also have a little brain. They don't understand the nuances of the market. So they are made to talk only their language of Reliance 5,000 3 years, Reliance 5,000 3 years. That is why everybody will be made to buy the Reliance. God forbid, after 3 months or 6 months, something happens to Reliance or any other company that is suggested in this fashion, and the company's operations have come to a standstill, every investor will stand to lose, because everybody went with the same theory of Reliance. And there are flaws in that, because every investor is going to be made available with the latest data as per the mandate, because the laws have changed over a period of time. Every 3 months, they have to announce the results. If you see the results going down, why should you hang around with the same company? So buy and forget is no longer valid for a company which is not doing well in the subsequent periods after you buy. Which brings us to the topic of, everybody should be aware that the stocks being held by them in their portfolio must continue to do well to be eligible to be stayed, to be invested in the portfolio. That means for me to hold the Reliance for a longer period, every quarter I need to check it is doing well, only then I would allow to keep it. That is the minimum understanding required. Second thing is, imagine yourself going from Hyderabad to, let us say, Vijayawada via taking a train which is set to go to Chennai. When you go to Vijayawada, your station has already reached. If you don't get off from the train, what happens is you will reach the Chennai and then you have to come back again. The same way, in the stock market journeys, when you buy a Reliance share, you have to have an assessment that, given the latest set of fundamentals today, what is the fair value it should go up to? Because the price goes up and down every day. You have to have a value that is the maximum it can reach, or some fair value. That is what Vivekam gives. This is the fair value based on the fundamentals. If the fair value is reached, you are supposed to sell it. Why you are supposed to sell is because this has discounted all the information, and this is the price that we expected this to be trading at if all the information is circulated to all the investors and everybody understands in the right spirit. And now the price has reached. If you get out, you can have the money invested in some other company, because you identified the Reliance when it was 2,900 and you are able to get out at 3,500. When you had the conviction that Vivekam's approach or somebody's approach in identifying low value growth stocks is true, the same philosophy should be there when you sell Reliance also. When you get out, you can recirculate the money in some other stock that is growing but still underpriced, and wait for it also to go up. But here is the catch. Many investors are getting confused between the old philosophy and the Vivekam's philosophy. Vivekam says every 3 months the fair price has to be reanalyzed and reviewed and then reported. Otherwise, what happens is the one price holds for 3 years is not what we practice or preach. So we need to remember the fair price is subject to revision every 3 months. Now, for you, if you have bought a Reliance share or some share based on the Vivekam's recommendation, you are supposed to get out when it reaches the fair price. Then the question comes. Many investors keep on asking the same question again and again, over and again, because new breed of investors come, new set of viewers come to the program, and they ask the same thing. Where is the validity? By what time can I expect the fair price to touch? You, me, all of us put together also cannot push the market up or cannot push the market down. Market is influenced by the individual investors all across the globe. So we don't have any say on that. But what we can say is, analyzing the fundamentals, fair price is fixed. If it reaches, we sell because we know how to spot the companies that are trading low on that day. Use the money to invest there. But then many investors keep on asking us, sir, after you said we sold the stock, it has gone up. It has gone up. Because the people are more concerned, they don't want to see an upside after they exit the stock. That is the problem. You should never have a feeling that some price, some stock after you sell should not go up at all. You cannot assume, because if everybody believes that, you would not have made money by buying at low and selling at a high price. So having said that, why you should not be worried, I want to show you with an example today. There are two slides I'm going to share with you today. Number one, only in the month of June, because I don't want to take you back in the history and then say we were good. In the month of June, there was some stocks suggested by us to be exited because they reached the fair price. This answers one point raised by many investors. Will it reach? What is the validity? Several times we can do only buy and then hold it. If it reaches, we sell. If it doesn't reach, we hold it because the company is still doing well. And next quarter, if the results are not doing well, if the results are bad for the company, no matter what the price of the market is, we will sell it and then move on to a better stock. So you intend to keep only good stocks in your portfolio and then be willing to sell at a fair price. Now, if you focus your attention on the slide, there are 20 companies approximately which were recommended by Vivekam to be exited by its investors because they reached the fair price. How do you know if fair price is reached? As you can see from the table, the first column is the company name, second column is the quarter, next is the exit reason. Everything is given is only EMP exit. That means expected market price reached. That is why exit is given. And the dates on which the exit is given also is given there. So for example, in Russell India, if you see, this is from the 2013-2023 December quarter. Now you understand. This company was bought in Russell in 2023 December quarter, maybe in January or February, and it is continuing in the portfolio after 2024 March results also, which means this company failed to reach the fair price before March results were out. So that's okay. And when the fair price came, the fair price is still higher than the market price, so it is allowed to continue. So it is moved on to the 2024 March also. That is why selling without reason is not justified. We will not suggest you to sell just because the quarter rolled by. Only if it reaches the fair price or the company's performance suffers, only then we sell. This company did not do badly in the next quarter, so we allowed it to continue. And we asked you to sell at 505, people sold. And what is the current market price today on 21st June? 475. So it has gone down by approximately 30 rupees, which is equal to 6%. Like that, if you see, there are a lot of companies which are appearing in the list. But you must focus your attention at the bottom of the list. If you see the second last one in the list, Bharat Forge was recommended by us long back based on 2023 December quarters again. It was bought and the people were holding it, and we asked the people to sell at 1604 being the fair price. And it has gone up afterwards to the kind of displeasure of many of the investors. They see, sir, we sold at 1600, now it is 1760. If we had waited, we could have made more money. Their argument is correct, but can anybody expect to sell at the highest, buy at the lowest? There is nobody in the world who can do that. That's what Ashwant has already made. Nobody will be able to buy at the lowest and sell at the highest. The moment you sell, you need not be worried because you identified the same Bharat Forge when the price was lower and allowed traveled with it to reach up to 1600, you sold it. Now use this money to buy another stock which is low price today and wait for it to come up. No. So what you must learn is, don't be worried about the possible upside after your sale. Try to understand what is the possible upside of the new shares that will come into your fold. To prove my point, apart from giving you this list of companies, I'm moving on to the second slide on the today discussion. Now you have a different set of companies. These are the 17 unique companies recommended by Vivekam in its top recommendations, top 10 stocks, because we come out with the top 10 stocks in any given day. These were all the top 10 stocks given, unique companies that were given in the month of June. And as you can see, on 5th of June, EFC was recommended. And what is the price at which it recommended? 386. What is the peak it touched already in the last 15 days? Because 5th June it is recommended, now we are in 21. In just 15 days, it has gone up to 618. That means it went up by 60%. That means what you lost in Bharat Forge is 10, whereas what you could have made probably 60% if you had gone into this. People will argue, sir, you recommended Bharat Forge to be sold on 8th, whereas you are trying to talk about EFC now. Now, if you go to the 10th item here, there is some company, Sasta Sundar Ventures, 10th June 24. It was recommended at 321. And what is the price it touched before this 21? 378. How much it has gone up? 17%. That means the money that utilized by you or earned by you when you sell Bharat Forge can be deployed in any of these companies, or you take any company for that matter, which was recommended after 8th June. So this kind of circulation will keep you safe. You will continue to make money. You will continue to be staying with the good companies, and no stock which is overpriced according to our estimate should be allowed to continue in your portfolio. That is what we always say. So once you follow that practice, you will have peace of mind, you will have prosperity, and more than anything else, you will have no question of tensions coming into your mind, because you know you are holding the good stock, you know they are trading below the fair price. So you don't need to be worried at all. And have a faith that the process has the ability to pick the undervalued growth stocks at any point of time. So never be afraid of selling, never be afraid of reinvesting the money in the growth stocks on that day. This is what we wanted to convey today. And after this month is over, June month is over, July results start coming in. And this week, only for this week, we wanted to cover a concept so that English viewers who are watching and who are walking into our fold now will have an understanding of what the Vivekam's philosophy is. If you still have any doubts, please feel free to write to info@vivekam.co.in for any clarification that you may require. We will be more than happy to help you, or pick up your phone and then send a WhatsApp message on 9100009891. Or, as I said, you can write to the email. So these things will help you to reach to the concept and the core values that Vivekam is built on and thriving.
Right, Mr. Prasad. So with that, let us conclude. Like we mentioned, if you have specific information that you would like to seek about a particular stock, do not hesitate to reach out to us at info@vivekam.co.in, or you can also be active on YouTube and write in the comments, because we are going to be a little more active and try and reply to comments that you put in and gather interest from you. So with that, let us conclude this week and let us again catch up soon. Thank you.